Good Sunday night, everybody. Luke Gromen, founder and president of FFTT, Forest for the Trees. Hope you guys have had a great weekend. And good Monday morning to those of you over in Asia and Australia watching. Hopefully things are going well so far this week for you. Just wanted to highlight two things that grabbed our attention recently. Going to run through them, two of them quickly like we have been, and then open up for questions for maybe 15 minutes or so. So the first thing that grabbed my attention recently has been just the degree to which it just seems like my news feed is all negative China all the time. No matter what, it's negative. So for example, I retweeted something today, a Bloomberg article noting that a whole bunch of housing stock in China that was built before 1999 is of such shoddy quality that it's going to have to be torn down and rebuilt. And in fairness, that is a bit of an indictment about construction quality, etc. But what's really interesting is this was the entire premise of cash for clunkers to the United States, which was good for GDP. This was the entire premise of every economist after a hurricane in the United States who comes out and says, yeah, XYZ state just got wiped out, but it's going to be good for GDP for a couple of quarters. And so the point here is simply to I think it's very important to see the bigger picture and really try to look at things with a grain of salt and from both sides of the equation, not black, white, and gray. The one thing that I am noticing in sort of the all negative all the time on China narrative is that there is still virtually nobody asking the question or discussing what happens when China gets the ability to print yuan for oil and other critical imports. And the reason I think nobody's asking the question or discussing it is because it's hard to make the next series of steps after they gain that ability fit into the narrative of all negative all the time. So something we're still watching for. It's still something that's developing, but it is developing fairly rapidly. So that's point number one. Point number two, as you might imagine if you were looking at our Twitter feed today, is this regarding Saudi Arabia, this Al Arabia op-ed in which they noted that there would be a number of potential, threatened responses if the United States sanctions Saudi Arabia over the alleged murder of a Washington Post journalist. The thing that really grabbed our attention, of course, is how quickly they went right to, quote, we will price our oil in yuan, we'll move away from the dollar, which is a fascinating development to me. This is something that was considered crazy less than 12 months ago, and now here you have it being threatened in response to this. Will they do it? Will they not? It is not an official Saudi threat. That said, it does seem to be something that you're probably not going to deviate far from the official script if you're in their media. And the other thing is that it does tie in with something over 12 months ago, where they announced they would look to consider funding in yuan, which would imply they'd be considering pricing oil in yuan as well. So for me, the bigger picture read at this point is less, are they going to do that? Are they not? I think it would be tremendously important if they did. But an important mile marker, they use the threat, or the threat is being communicated. This is important because it begins to shift the power dynamic away from the dollar side of things towards Saudi. Anytime the fact that a yuan contract exists, Saudi can threaten, hey, we're just going to go price oil in yuan, and it puts the U.S. on their back edge. Hey, we're just going to go to the Russians and buy S-400 missile system. It puts us on our back heels. The world is getting more multipolar, and that's a very big change versus the past 30 to 35 years, and I think that's the real key takeaway in all of this. So I'm going to open up here for questions for a bit. Before we do that, check out our website, FFTT-LLC.com. This coming November, we haven't set a firm date yet, but we are going to do a full 2-hour webinar with slide deck, full Q&A for a limited number of seats available for this webinar, though. And so, if you're interested, we will be offering those seats out to people on our mailing list first, on a first-come, first-served basis. And again, you can sign up for our mailing list at FFTT-LLC.com. So check that out. More details forthcoming on that as we get that all firmed up. So with that said, I'm going to open up for questions for a couple of minutes. Let's see what we got here. What's going on with gold? I think it's just more of the same. One thing that has grabbed me, we've been talking about this run on gold, physical gold that has been taking place as you've seen GLD drained, COMEX drained of physical inventory. One thing that grabbed my attention late last week was you had 2 days of very big tonnage additions to GLD. I think 8.5 tons and 5.5 tons in 2 consecutive days. First time that that's happened in at least 6 months. It did remind me a bit of the reversal we kind of saw in late 2015, where it had been inventories down for almost 18 months. And then all of a sudden, up 20 tons, up 10 tons for a couple days. And in the first quarter of 16, gold was up 30%. It was almost like someone was putting gold back into the system, and it would allow the system to start re-leveraging again. So I'm not saying that that's what's happening here, but the reversal in terms of big tonnage 2 days in a row in GLD, I thought was noteworthy, and we'll see how that develops from here. Hey, Luke, your opinions on how the bond yields are going to react before the Fed reverses to QE. I think the Powell put or the Fed put has a lot more to do with what's going on in the Treasury market with yields than it does with risk assets. Again, last week we of course saw a couple big risk-off days. I thought it was very instructive. We needed 1,300 points or so down on the Dow in order to just get yields down a little bit from call it 323 to 315 on the 10-year. To me, that speaks, as somebody said to me, hey, that the trilemma's back on. And it speaks to that U.S. trilemma where the Fed can have only 2 or 3 of a stronger dollar, rising rates, and rising equities. So I think all else equal, bond yields rise until the Fed is forced to respond to that. When will China have the ability to print yuan for oil, in my opinion? I think it's starting. Look, we just had our first settlement month, physical settlement month of yuan oil in September. It was a de minimis amount. I want to say it was 500,000 or 600,000 barrels for the month, not per day, but for the month. Basically trying the system out, running small flows through it. The next big settlement month is December. I checked a week or two ago. Open interest on that contract is 44 million barrels. Don't know what percentage they're settling in, don't know what percentage they would settle in. If you start talking about settling 1 million, 1.5 million barrels a day or more, again, that all won't settle. But if you're talking about a much bigger jump up is probably the better way to put that. That begins to have I think much more impact. As it is, it's interesting. Many people were saying this contract wasn't going to do any volume. In the first 5 months it was in existence, it reached market share levels that it took the Brent contract 20 years to achieve. And that was according to either Bloomberg or Reuters about a month ago. That story came out. A lot of it's retail volume, but at the end of the day, volume begets volume. You're working on creating a network effect and trying to drive liquidity pools. So the answer to your question, when will they have that ability? It's growing. The ability to growing. They're not fully there yet, but that ability is growing. And that is not simply a mechanical ability. There's political aspects to that as well in terms of being able to defend trade lanes, etc. And you got to believe with some of what's going on with the Spratly Islands and in the South China Sea has something to do with that. So I'll leave it at that. Okay, I just answered that one. Great news on the webinar. Thank you. Is the move in rates more supply growth inflation concerns or supply demand imbalance? Hi, Jack. Question from Jack. I think it's more supply-demand imbalance than it is growth and inflation concerns. And I think part of that, I think we're going to see here soon because I think I just saw the New York Fed taking their growth estimates down late last week. And, you did see rate yields come in a bit. But I think the upward trend is going to continue. I think this is a lot more about supply-demand. What happens to the dollar, the DXY index over the next year? I think we are much closer to the Fed being forced to either pause QT or begin to talk about pausing QT than most people appreciate. And I think a lot of the clues on that are coming on areas where people have not had to spend a lot of their time thinking about in their careers. U.S. fiscal situation, supply-demand dynamics. You had another sloppy auction last week. It was very interesting. Early last week, it was a 10-year auction that, after the 10-year had sold off sharply, I was a little surprised to see the auction not, it was not a very strong auction. It wasn't a horrendously weak one, but it was not what you'd expect after, the 10-year yield had gone from 2.95 to 3.25 on the yield from, in the span of a little over 3 weeks. And so that was a little surprising. The bottom line then is that translates back to the dollar or the DXY is I think, the Fed is going to have to back off a QT, and I think that's probably negative for the dollar over the next 3 to 6 months. Last week also became the second instance after February where yields rose to the stocks crash. Great analysis. Thank you very much. That is, to me, that's a very big, it's a problem. Obviously, the risk parity trade breaking down both in February and most recently last week, where yields rose as stocks sold off. That's problematic, but it makes sense when you really look at the structure of the U.S. economy now and how important rising asset prices are in terms of tax receipts, in terms of consumer spending. Let's see, if Saudi were to switch to yuan, how would this affect Russia and the ruble? I would think the ruble would rise against the dollar. I would think oil prices in dollars would rise. Ironically, a lot of what we're talking about here in terms of the dollar losing as much of its primacy as a reserve currency and being more of a first among equals as opposed to being the primary reserve currency is really good for a lot of the U.S. So, for example, if Saudi switches to yuan, I would think oil prices in dollars might be up a lot, potentially. I would think the dollar might be down against the ruble. But that's ultimately really good for industrial production in the United States. It's really good for industrial order rates. It's really good for employment. It's good for wages. It's not great if you have a portfolio full of treasury bonds, and it's not great if you are Washington and you need a system that lets you deficit spend without impact. But for the rest of the U.S., it's pretty good. How long can the ECB keep negative interest rates while interest rates rise in the U.S.? That's a great question. It's been one that's been a big head scratcher for a lot of people. I think where the rate differential just keeps climbing, and in the transatlantic rate differential, and the dollar's not responding yet. And maybe it's just a yet, but there is a point at which that if that transatlantic yield gap keeps rising and the dollar doesn't respond, or heaven forbid begins falling. Look, there is a point along that path where you go, wait a second, is this Mr. Market saying the U.S. is a riskier credit? And I think there's something to that. I don't think we're there yet, but to me, when you look at the balance of payments for the EU in total relative to the United States, ECB or the EU is in a much better position than the U.S. So if we're moving to a more multilateral system, all else equal, and all else may not be equal, but all else equal, you would expect the euro to rise against the dollar in a more balance of payment centric system. Is China selling treasuries weakening renminbi put pressure on the U.S. stock market ahead of the U.S. election? I think China's playing a little bit of defense with some of what they've been doing with the renminbi, letting some pressure out of it. I continue to hear that what they're doing with with the relationship between gold and the RMB since late March, early April is not coincidental. That there's a bit of a floor being put there by somebody, or a peg being put there by somebody. Those things can change, but that's what I continue to hear. I think China has been selling China has been selling treasuries for going on 5 years now. They announced 5 years ago, in November of 2013, that it's no longer in our interest to stockpile FX reserves, i.e. treasuries. And you can see it in the data that late 2013 Treasury holdings peaked. They've been trending downward ever since, with a couple big dips down and then a sort of a big increase back up. But they've never surpassed the level held at the end of 2013. So I don't think that they're doing what they're doing on Treasuries to try to influence the election. I think they are just slowly backing away from the U.S. Seeing the fiscal situation, seeing what China needs to do in terms of, it's not like they have a clean slate they're operating with. They have some constraints they're trying to manage within as well. So I don't know that it's, that they're trying to do something direct to hurt the U.S. that way. I think it's more just, kind of continuing what they've been continuing and managing with some of their own constraints. Let's see. Can I comment? Let's see. If we see a crash, what do you see mining stocks doing short term? I don't know. If we see a crash, I'd expect to see everything gets sold, but I would probably go with that, like gut. A real crash. The reason I kind of stumble with that a bit. Number one, you saw mining stocks do well last week. I wouldn't call what we had last week a crash, but that was of interest to me. The other reason I sort of stumble on that is if there's a crash like '08 in the U.S., we are in a very, very different place from a fiscal situation. We're a very different place from a multilateral development of the currency system situation. We're in a very different demographic situation. We're from a very different reflexive situation. There is nobody on the planet that doesn't think the central banks will do what they did. And back in '08, that was a surprise to most people. It's no longer a surprise. And so that's the one reason I kind of say, is it possible mining stock could rise rather than be sold? There's my thought process on it. How's that? Can I comment on MBS's regional and global ambitions? I am not a Saudi expert. I will say I think it is very interesting. We've seen, this purge that we had almost a year ago, the quote-unquote purge, to the untrained eye, and based on some of what I read in the Wall Street Journal, a number of the people housed at the Ritz could be construed to the untrained eye as U.S. sympathetic or U.S. allied. I don't know what that means in terms of why those people. There are people that are better served to answer that question or better prepared to answer that question. So, to me, there definitely seems to be something afoot. Now this latest situation is definitely noteworthy in that, while tragic, it is getting a disproportionate amount of attention relative to other events that I would argue, have been more tragic, more impactful, affected a greater number of people than this particular incident, and that always gets my attention when responses to something seem disproportionate relative to the quote-unquote crime. So that's what I'll say at this point about that. I'm not really well informed enough to comment in terms of what I think his global ambitions are relative to Iran, Russia, etc., some of those types of things. All right, well, I'm going to jump here, everybody. Thank you for jumping on. Let's see. One last question I guess I'll take here. Will additional QE be neutralized by banks just holding excess reserves rather than lending them? It's possible. But again, you're talking about a very, very large amount of reserves that would have to be sterilized by the banks. Probably be a good deal for the banks. They can create money out of thin air by treasuries, capture the spread, and never have to mark them to market, and if they're classified as held to maturity. But again, there are puts and takes to that. There are other considerations. What would that mean for the currency if your banks are financing your government to the tune of $200, $300, $400 billion a month in terms of QE? So that's something for another time. So thank you all for logging on, and have a great week. And we will. How do we subscribe? So we have a couple different options. The first, is to check out Tree Rings, which is if you go to FFTT-LLC.com. There's some information about that. You could also go email info@FFTT-LLC.com. thank you guys very much, and we'll talk to you soon.